Hello, Felipe again. This time, problems in conventional finance. This is part two of Catholic social teaching and impact investing. In part one, we talked about how climate risk is underpriced. We showed that by doing some simple carbon math about the remaining carbon budget we have with 225 gigatons of carbon and our current rate of emissions at 35 gigatons and the total proven oil reserves that are on the balance sheets that are factored into the market capitalizations of oil companies around the world, 2,600 gigatons of carbon. That's how much they are planning to produce and sell to market. And that's what when we buy their oil company prices that have been going up, that's what it's predicated on. That's part of the market capitalization. We know that this simple carbon math is leading to an unlivable future, and that's why we're talking today. Now let's take a step back. In conventional finance, I remember when I first set up my 401k, everyone said, just get an index fund. It's the best low-cost way of doing things. Now, those index funds are based on some conventional wisdom that we all share today around what we expect capital markets will do over the next 10, 20, 30 years. And everyone says over the long run, over the next 20 years, we expect US equities, US stocks to go up about 6.5%. And historically, that's been true, 6 and 8.8%, as this Fidelity chart shows. That proceeds for any kind of equities here. As you see, 5.9, 7.9%, in bonds. The 20-year estimate's less than 1%, but historically it's been 4%, in cash. Here we have their returns. Now, this is the conventional wisdom. Now, the question I want to ask you today is, does this rear view mirror looking way of setting expectations make sense to you? Basically, as you can see, people are just using the historical past 70, 80, 90 years as the precedent for what's going to happen over the next 20, 30, 40 years. Now, does that assumption make sense to you? I'm going to show in the next few charts why I do not think it's true. Let's start with the Federal Reserve. This chart shows the S&P 500 forward price to earnings ratio. And as you can see, 2019 here, it's roughly going up and down. The red line is the Federal Reserve's total assets. This is the balance sheet of the Fed Reserve. As you can see, in March and April, it goes up drastically. Now, the Federal Reserve's balance sheet was about $1 trillion up until the Great Recession of 2009-10. And through quantitative easing, a bunch of purchasing of mortgage-backed securities, it added about 3 trillion. So we're at about 4 trillion. And then in April, you see more than 2.5 trillion was added to the Federal Reserve's balance sheet. And that coincides right with the stock market crashing as the pandemic hits at the end of March. And then very soon, the early April here, as the Federal Reserve begins buying assets at dramatic paces, unprecedented paces, the stock market recovers and has done very well the past 12 months since then. And just to put in context, what does $3 trillion look like and feel like? The total US farmland, all of farmland in North Carolina, Nebraska, Kansas, Utah, added up, the total value of those 900 million acres is about $3 trillion. So think about all the farmland you've ever seen put together. That's approximately the value we're talking about that the Fed added to its balance sheet just in the few weeks after the pandemic started. I'd also like to show you here how markets, I think, have been disconnected from our economic reality. And I think we can see that particularly acutely in the past 12 months. So this forward earning per share is one line here, and the other line is the NASDAQ. Now, the earnings per share is a conventional way to say our stock's appropriately priced. Now, as you can see, the NASDAQ has gone up quite a bit since March, while earnings per share has dropped precipitously since the beginning of the recession. So these are just the first 3 months of 2020 after COVID hit. But I think it shows how disconnected our financial markets are, our stock market, and as a result, any of our index funds. And I think we've all loved seeing our index funds grow so significantly. Everyone loves how much that goes, if you have money there, of course. But I think it to totally disconnect from the reality that most people in this country and our world have lived this past year. Now let's take a close look at what some of the leading Wall Street hedge fund managers. This is from GMO. This is what they predict as the annual return forecasts. Now, how do you read this? Well, let's assume over the next 7 years, what would you expect the average return would be? Now, for U.S. large and small equities stocks, they're expecting 5.8% and 7.1%. So that'd be 5.8% drop in the value of stocks every year for the next 7 years. So that's 7 times almost 6. That's almost a 35% drop in your large equities. And for small equities, again, 7 times 7, almost 50% drop. So they are saying here with this forecast that your current stock market holdings, if you have any of Amazon, any of the big US equities, they're 40 to 50% overvalued. Now, this goes for the whole US equities, and you can see that kind of carries over for bonds here too. And it's only emerging value that is not there. And that's kind of a hedge fund construct. So not something that most retail investors like us have access to. So I hope this just gives you a sense of where people think things are going over the next 7 years. And I think this is a logical question of, like, let's invest in something that's more connected to the real economy. And that's what I think it maybe is a ripe opportunity to consider some alternative investing opportunities. So what I just tried to go through quickly here is looking backwards the best way to look forward. As GMO forecast shows, asset classes are currently badly mispriced. I think there have been secular shifts in interest rates. I didn't show the chart, but basically through the 70s and 80s, we had interest rates going up to the 90s. And then since the 2010, we've had interest rates go down to zero. And we've been at roughly zero price borrowing money. The federal funds rate is around 0.1% over the past 10 years. And so that's been a secular shift. We've never seen that looking back over the past 50 to 70 years. Then we talked about quantitative easing, which is this Fed's purchase of more than 3 trillion this year, adding to the balance sheet. I talked about the great decoupling of the market reality or the market economic realities and the markets. And another way to think about that is that the global GDP is about 75 trillion. All the goods and services produced, measured. Now, there's not all of them. Of course, that's not measured in GDP, but let's just take that measured today, 75 trillion. And then let's take about what are all the stocks and bonds that are traded? What's the volume that's traded? And then all the derivatives and options. There's more than 1,200 trillion that's traded every year when you add up all these financial instruments. And so there's basically the creation of this artificial economy on top of the 75 trillion that's the actual goods and services exchanged. So much more happens in this artificial economy. In addition to that, we talked about how climate risk is underpriced. That was the part one. And then also the socio-political risks. I think it can't help but realize that Black Lives Matter has fundamentally changed the conversation in this country. This past year, we've had the largest protests, even larger than the civil rights in the 60s. Obviously, the pandemic, COVID. We have January 6th insurrection at the Capitol. And then we also have the refugee crisis that has been ongoing and will continue to be exacerbated by disasters, climate related and otherwise. So what's your best thinking? Is the right way to think about your future investments by using the historical, what they've delivered for you? And I think it's also helpful to think that U.S. equities and all equities are basically investor owned, right? All the interests of a firm, all the management, the executives, the board of directors allocates the surplus, the profits, which goes to reinvest in the company to be able to make more profits both now and in the future. So investor interests are always maximized, and other interest workers, yes, to the extent that they help investors, they're considered. Environment, they're considered. But capital's interests are supreme and reign supreme. And that's why we're able to get such good historical returns. Are we going to get that going forward? I don't think so. So this then turns us to the opportunity of impact investing. In impact investing, we try to get some climate impact, correct? We try to get some social impact. We try to help build, wealth for other communities, affordable housing. But I think it's also important to realize that the conventional financial mindset, I think, has caused some significant problems with impact investing that I think many of us aren't aware of. So I want to review them. And this is from Morgan Simon's book, Real Impact, The New Economics of Social Change. And just by highlighting these pitfalls, I think it points to what we can then draw on with Catholic social teaching as a potential way to mitigate many of these. The first thing is that, investors and entrepreneurs profit but it's at the expense of community. And basically that ownership is limited to the privileged, those who are building the business. I think we can use examples here, but I think you get the idea is that communities aren't involved in the ownership and governance of many enterprises. So even though there is positive social impact, there is positive environmental impact, and investors are doing great and entrepreneurs are profiting, it's at the expense of other community stakeholders that aren't involved. Another similar related challenge is that impact is being defined by investors and entrepreneurs instead of the beneficiary community. I think this is a really significant issue in microfinance. I think we've become such a top-down industry that it makes it impossible for community to set the agenda with their needs. For example, microfinance in Peru, for example, a project that we think we did well, that we installed thousands of trees, or a new water system for Pachacutec in this shanty town outside of Lima. And this is an actual project I worked on about 15 years ago. Even though the water system was installed, it was never utilized because it wasn't connected up to the state-owned system. And so an impact investor got a return, created water infrastructure, did all these great things for these 100,000 people in the shanty town. But the actual beneficiaries, the actual community didn't say, oh yeah, that was truly impactful for me. And there's many examples that Morgan talks about in her book, Real Impact. Too often, I think we take the easy wins and celebrate incremental change rather than the restructuring of our economic system that we know is vital to tackle the climate and socioeconomic political questions that are so vital for our sustainable future. And I think this is reflected best for me in just renewable energy. I think we can realize that a one incremental solar project is better. We can recognize that wind projects are good. And these are good, easy wins, but we have so much other things that's enabling them. And so it's not fundamentally changing how things work. And I think that's something I think we have to wrestle with, is what we're trying to actually accomplish with our investments today. There's a huge capital gap for community run and led projects. This is so important. And this is, I think, what we can get to when we bring in Catholic social teaching. But right now, too few of us are investing in community run and led projects. And I think philanthropy has begun to recognize this in significant ways as they've realized how few of their dollars go to Black-led nonprofits. Capacity building and startup capital is lacking for the 99%. We know the friends and family problem. Those of us with white skin have more than likely benefited from FHA and GI and so many policies that have systematically advantaged white families. As a result, those of entrepreneurs of color, those coming from communities most on the margin and the periphery with ideas to serve their community and restructure the economy, they don't have access to friends that can help capitalize them, even with a few $1,000s to do a study, to do a business plan, to spend the time to start up the business. So how are we expecting wealth building to be available to all when they don't have startup capital? This is a critical problem that I know many micro-entrepreneurship folks are really focused on, and community development is seeing this. I think it's also good to realize that impact investors, all the big impact investing funds, have a long way to go in addressing race and gender dynamics. And it's important to realize that while the journey may have started, there's a long way to go. Finally, I think social education is not being taken as seriously as financial education. We always go to more financial conferences, financial ongoing learning. How often do we go to the margins to accompany the poor? How often do we value that social education just as much? It's so easy to go to a handful of meetings with other investors or other peers. How often do we go to the enterprises that are led by Mayan immigrants? How often do we go to see what it looks like, the green worker cooperatives in the Bronx in New York? How often do we go to the border to see the migrant farm workers that are creating worker-owned food co-ops, that are creating worker-owned landscaping firms and janitorials? How are we appreciating, empathizing with where they're at? That social education, I don't think, is something we can all invest in to be much more serious about this. Finally, I think it's important that one of the biggest challenges I see and I hear from impact investors often is that there's those that are in the market rate camp, that we can do impact investing and get market rate returns. And we can also, and that conflicts often with people that say, no, our impact investing is often at concessionary returns. We take less than 5%, or we take 2% or 3% as the returns we expect. And this kind of dichotomy between concessionary and market rate, I think, creates an unhelpful separation in what's actually happening. So what is market rate? What are those benchmarks? Remember, what are the underlying investments that determine what a market rate is? I I think it's important to realize that prisons are part of that. We all know the core civic story, that basically there's 90% occupancy that's been mandated in there. So of course government has to do things to get 90% occupancy. There's factories that use sweatshop labor. There's land deals that displace small farmers. There's industrial manufacturing with minimal regulation on hazardous waste, DuPont, Teflon. There's oil companies with valuations that we know are going to create an unlivable future. So is really market rate our standard for comparison? I think we need to ask ourselves some hard questions. These are a few of the sources. And I want to end here. While I've covered a lot about the problematic nature of conventional finance, I also want to invite you to think about how you might be a protagonist for the transformation we need. I believe we need protagonists from all corners. This is our future. This is your future. We have a newsletter, ownershipmatters.net. I hope you'll follow along with us.